The global food industry rests on a financial structure that is both familiar and deeply hidden. People see the shelves in markets and the displays in bakeries and restaurants, but they rarely see the flows of capital that allow these goods to reach them. The food business is built on a sequence of financial decisions that begin long before a seed touches the soil and continue long after a customer pays at the counter. Each step in this chain contains its own risks and its own logic. At the very beginning there is the cost of land or the cost of leasing land. Farmers and primary producers often work with thin margins. They borrow capital during planting seasons, rely on regional subsidies, and negotiate forward sales to secure a minimum revenue before the harvest. Their financial reality shifts with every change in weather, every alteration in demand forecasts, and every sudden movement in global commodity exchanges. When grain prices rise, producers enjoy a small advantage, but when prices fall they struggle to repay seasonal credit. This delicate stage forms the financial ground on which the entire structure of the food industry is built. Once raw materials are produced they move into the hands of traders. Large trading companies operate at a scale that allows them to influence both price and availability. Their financial operations are heavily dependent on futures contracts, hedge strategies, and transportation cost management. For them the flow of food is also a flow of capital. They monitor shipping costs, energy prices, and storage expenses. A small fluctuation in fuel costs may change the profitability of an entire shipment. Traders often manage multiple locations across continents, so they must deal with currency risks and political risks. A region under unstable governance or facing sudden regulation may interrupt supply and create short-term shortages that reshape global prices. After the trading stage comes the processing stage. Processing companies transform raw materials into forms that can be sold to consumers or to restaurants and retailers. They operate large facilities that require significant initial investments. Factories need expensive equipment, routine maintenance, safety checks, and strict quality monitoring. These facilities rely on a steady inflow of raw materials and a predictable flow of orders. Much of their financial planning revolves around efficiency rates. Even small delays or losses in production can damage annual profits. Processing companies also negotiate long-term supply agreements to secure stable prices. If they fail to do so, they may face sudden rises in ingredient costs that can erase their margins for months. Brands and manufacturers with wide distribution reach invest heavily in research and development as well as marketing. They track global consumer trends such as rising interest in sustainable farming or plant-based diets. Developing a new product line may require long periods of testing and package design before it reaches the market. Financial departments in these companies constantly run models to predict the success of new products. If a new item fails to attract consumers, it becomes a financial burden that must be discontinued. These decisions determine which products survive and which ones vanish before customers even notice they existed. Distribution networks form another essential link in the financial ecosystem of food companies. Transporting goods from factories to warehouses and then to retail locations requires fleet management, route optimization, refrigeration systems for delicate items, and careful coordination with retailers. Distributors usually work with thin margins due to intense competition. Small inefficiencies such as lost inventory or delayed deliveries may translate into notable financial losses. In some regions, distributors combine their operations with retail chains, which allows tighter control of costs and greater predictability in supply. Retailers constitute the last major corporate layer in the food chain. Supermarkets and smaller markets rely on precise inventory management. They track expiration dates, consumer demand patterns, and seasonal shifts. Retailers negotiate prices with manufacturers and often require promotional support. When a product is placed in a prominent shelf position, that placement is usually the result of a negotiated financial agreement. Retailers use loyalty programs to collect data which helps them predict which items will sell quickly and which will stay on shelves longer than expected. The finances of large retail chains depend on both rapid turnover and effective management of operating costs. Even small changes in electricity bills or staffing levels can influence quarterly results. Meanwhile, restaurants operate with a completely different financial rhythm. They must balance the cost of ingredients, staff, rent, and utilities while offering meals at prices acceptable to customers. Restaurants operate with narrow profit margins and can be heavily affected by regional economic conditions. A rise in the price of cooking oil or meat can disrupt their financial planning. Many restaurant chains try to secure long-term supply contracts to stabilize ingredient costs. Independent restaurants that lack this scale must adjust menus or adjust portions to maintain sustainability. Above all these layers sits the influence of global investment funds. Large institutional investors hold shares in multinational food companies. They expect stable performance and steady growth. Food is considered a relatively stable sector, but investors still demand efficiency and expansion. Their expectations influence the strategic decisions of corporations. A major company might close a factory in one region to open another facility in a region with lower operating costs. These decisions are not only operational but deeply financial. They change the employment landscape of entire regions. Another influential factor is the cost of compliance with regulations. Food companies must follow rules concerning safety, labeling, environmental impact, and labor conditions. Compliance requires both money and time. Failure to comply can result in heavy fines or reputational damage. Financial departments therefore allocate funds to ensure that audits, training, and safety systems are constantly updated. In some cases, companies invest in environmentally friendly technologies not only for ethical reasons but also because doing so reduces long-term costs or opens access to new markets with strict standards. Logistics and transportation shape the flow of money through this system. Companies calculate the most efficient routes, select between shipping and trucking, and balance the cost of speed versus the cost of storage. Global food companies deal with the reality that perishable goods require rapid transport. They calculate how long goods can stay in transit without losing quality. Delays at borders or in ports can cause financial losses. Many companies therefore maintain their own distribution centers and cold storage facilities to protect themselves from unpredictable delays. Digital transformation has added another layer to the financial operations of food companies. Data analytics allow companies to track inventory at minute scales. Artificial intelligence-driven demand forecasting tools reduce waste and improve planning. Online sales channels require investments in software development and customer service. Companies now treat digital infrastructure as a major financial asset. They pour funds into platforms that can handle online orders, track customer preferences, and adjust promotions based on real-time data. Risk management is a central aspect that often remains invisible to the public. Food companies must consider natural disasters, geopolitical shifts, currency swings, and health crises. Each of these events can disrupt supply chains. Financial departments build contingency plans and create emergency funds. They insure warehouses, crops, vehicles, and equipment. Insurance premiums form a significant part of operational expenses. When disasters occur, insurance payouts help stabilize the company but do not always cover the full extent of losses. Marketing budgets represent another major financial component. Food companies spend enormous sums to shape consumer preferences. They pay for advertisements on television, digital platforms, and billboards. They sponsor events and collaborate with influencers. The aim is to secure market share in a competitive environment. Marketing departments work closely with finance teams to calculate the return on each campaign. A successful advertisement may raise product awareness for years while an ineffective campaign becomes a financial waste. Sustainability has become both a moral and financial concern. Many companies now invest in renewable energy, recyclable packaging, and sustainable farming programs. These investments require substantial funds at the beginning but may reduce long-term costs. In addition, companies that demonstrate commitment to sustainability often attract favorable attention from environmentally conscious investors. For these reasons, sustainability has moved from the margins of financial planning into the central strategy of many global food corporations. Labor costs also play a critical role. Food companies employ millions of workers worldwide, including farmers, factory workers, drivers, technicians, marketing specialists, and sales representatives. The financial well-being of a company depends on its ability to attract and retain skilled workers while maintaining operational efficiency. Wage negotiations, training programs, and workplace improvements all require financial resources. Companies that fail to invest in their workforce often face high turnover rates, which lead to additional expenses. Food security concerns push governments to intervene in food markets. Governments may provide subsidies, price supports, or grants to farmers and companies. They may restrict exports to protect domestic supplies or adjust tariffs to stabilize prices. These policies affect the financial planning of companies. A company that relies heavily on international trade must constantly adapt to regulatory changes. Long-term contracts may be disrupted by sudden policy shifts, forcing companies to renegotiate terms or alter strategies. In emerging markets, the financial landscape is shaped by rapid changes in population, income levels, and consumer habits. Food companies entering such markets must make large initial investments in distribution networks, production facilities, and marketing campaigns. They expect long-term returns but face uncertainties including political instability and fluctuating demand. Successful expansion into emerging markets requires a careful balance of risk and reward. At the core of all these financial movements is the fundamental truth that food is both a necessity and a business. People must eat every day, and this stable demand creates opportunities for companies to grow. Yet stability in demand does not guarantee stability in profits. Companies must manage complex networks of suppliers, partners, and customers. They must predict future trends in consumption while adjusting to short-term changes in cost. This vast system of interconnected decisions forms the financial inner world of food companies worldwide. It is a world shaped by risk, strategy, and constant negotiation. It affects the choices available to consumers and the prices they pay. It influences the livelihood of farmers and the development of communities. Though often invisible, it is one of the most important financial ecosystems in the global economy.